The intelligent investor. Imagine that two friends begin investing on the very same day. They have similar incomes. They invest roughly the same amount of money. Neither of them has insider information. Neither has a financial degree. Yet 20 years later, one of them has built substantial wealth while the other is still chasing the next big opportunity, wondering why success always seems just out of reach. What created such a dramatic difference? Most people would assume it was intelligence. Others might say luck. But Benjamin Graham, the author of The Intelligent Investor, believed the answer was something much simpler. The winner wasn't necessarily smarter. The winner was more disciplined. And that idea sits at the heart of one of the most influential investing books ever written. What makes this fascinating is that the book isn't really about stocks. It's about human behavior. It's about decision-making. And it's about learning how to stay rational when everyone around you is losing their minds. Before we explore those lessons, there's something surprising you should know. Many people open this book expecting a collection of stock-picking secrets. Instead, they discover something much more valuable. They discover a framework for thinking. A framework that has helped generations of investors navigate uncertainty without becoming victims of fear or greed. To understand where these ideas came from, we need to understand the man who created them. Benjamin Graham lived through some of the most extreme financial events in modern history. He experienced prosperity. He experienced devastating losses. He witnessed market euphoria. He witnessed panic. While others searched for ways to predict the future, Graham focused on something entirely different. He focused on understanding how investors behave when emotions take control. Over time, he noticed a pattern. Markets were constantly changing. Companies came and went. Economic conditions shifted. But human nature remained remarkably consistent. People became overconfident during good times. People became fearful during bad times. And those emotional swings often led to terrible financial decisions. That observation became the foundation of The Intelligent Investor. Years later, one of Graham's students would take those principles and build one of the greatest investing careers in history. That student was Warren Buffett. Buffett has repeatedly praised Graham's teachings and credited many of his investing principles to lessons learned from this book. That alone should make us curious. What ideas could be so powerful that they influence investors for generations? The answer begins with a simple but often overlooked distinction. Price and value are not the same thing. At first, this sounds obvious. Yet most investors spend their entire lives confusing the two. Imagine walking past a luxury watch store. One day, a watch is displayed with a price tag of $5,000. The next day, the same watch is marked at $3,000. Has the watch changed overnight? Of course not. Only the price changed. Yet when stock prices move, people often assume the underlying value has changed as well. This is where many mistakes begin. Graham argued that intelligent investors focus on value first and price second. They understand that markets are emotional. And emotional markets often create opportunities. This idea becomes even clearer through one of Graham's most famous teaching tools. Imagine you own part of a business with a partner named Mr. Market. Every morning, Mr. Market knocks on your door and offers to either buy your share or sell you his share. Some days he's enthusiastic. Everything looks wonderful. He believes the future is bright. On those days, his prices are incredibly high. Other days he's discouraged. He sees problems everywhere. He expects disaster. On those days, his prices become surprisingly low. The important thing is that you are never required to accept his offer. You can simply ignore him. You can wait. You can make your own decision. And that's exactly how the stock market works. The market gives you prices every day. But it doesn't force you to act. Unfortunately, many investors do the opposite. They treat market prices as instructions rather than opportunities. When prices rise, they rush to buy. When prices fall, they rush to sell. In both cases, they're allowing emotion to dictate their decisions. Graham believed intelligent investors should do something very different. They should think independently. They should use the market rather than be used by it. Now this raises an important question. If markets are emotional and unpredictable, how can investors protect themselves from making costly mistakes? The answer may be the most important idea in the entire book. It's a concept known as the margin of safety. To understand it, imagine you're building a bridge. The bridge is expected to support 10,000 pounds. Would you design it to hold exactly 10,000 pounds? Probably not. You would want extra strength. You would want a buffer. You would want protection against unexpected circumstances. Investing works the same way. Whenever you estimate the value of a business, there is always uncertainty. No one knows the future with complete accuracy. No one can predict every challenge. No one can foresee every opportunity. The margin of safety exists to protect investors from those unknowns. Instead of paying a price that leaves no room for error, intelligent investors seek situations where there is a comfortable gap between what something is worth and what they have to pay. That gap provides protection. And protection is often more valuable than prediction. This idea becomes especially important when markets become emotional. Because eventually, every investor faces the same challenge. Fear. Or greed. Sometimes both. History shows that markets move in cycles. Optimism becomes excitement. Excitement becomes euphoria. Then reality intervenes. Prices fall. Fear spreads. Panic appears. Eventually confidence returns. The cycle repeats. Most investors know this intellectually. Yet they still struggle emotionally. That's because investing is rarely a battle against the market. It's usually a battle against yourself. Fear whispers that you should sell when prices are falling. Greed whispers that you should buy when prices are soaring. Both emotions feel convincing in the moment. And both can be dangerous. Graham understood that successful investing depends less on intelligence and more on temperament. The ability to remain calm during uncertainty often creates a greater advantage than the ability to analyze spreadsheets. Think about how powerful that idea is. You don't need to be the smartest person in the room. You don't need perfect predictions. You don't need secret information. You need discipline. You need patience. And you need the ability to think clearly when emotions are running high. Now let's bring these lessons into everyday life. Imagine the market suddenly drops. News headlines become alarming. Financial commentators predict disaster. Social media fills with fear. Many investors panic. But someone following Graham's principles approaches the situation differently. Instead of asking how low prices might go, they ask a more important question. Has the value of great businesses actually changed? Sometimes it has. Often it hasn't. And that distinction can create extraordinary opportunities. The intelligent investor doesn't ignore risk. They simply refuse to let fear make decisions for them. Likewise, when markets become wildly optimistic, they remain cautious. They remember that excitement can be just as dangerous as panic. This balanced perspective allows them to navigate uncertainty with greater confidence. Before we finish, let's connect everything together. Benjamin Graham's message is surprisingly simple. Markets are emotional. You don't have to be. Prices change constantly. Value changes much more slowly. The market exists to serve you, not to control you. Protection matters more than prediction. Patience often beats excitement. Discipline often beats intelligence. And the greatest investment advantage usually comes from mastering your own emotions. Now imagine yourself years from today. Imagine looking back on the financial decisions you're making right now. Will you remember today's headlines? Probably not. Will you remember the latest market prediction? Probably not. But you will live with the consequences of your habits. Your patience. Your discipline. Your ability to stay calm when others become emotional. That is the enduring lesson of the intelligent investor. Not that wealth comes from finding perfect investments, but that lasting success comes from making thoughtful decisions consistently over time. Because in the end, investing is not a competition against other people. It's a lifelong effort to think clearly in a world that constantly encourages emotional reactions. And those who learn that lesson often discover something remarkable. Building wealth becomes less about chasing opportunities and more about avoiding mistakes. And sometimes, that simple shift in perspective changes everything.